Thank you, Chinda. Hello, everyone, and thank you for joining us for this webinar on COVID-19 impacts to business valuation and forensic accounting. We started this series last week with 1 hour and quickly learned that we didn't have enough time. So we've expanded today's webinar to 2 hours, and the remaining in this series will also be 2 hours. We're joined again by leading experts in business valuation, forensic accounting, financial litigation, who are also prior board members or board chairs with the NACVA and instructors within various credentialing programs and continuing education courses. We have with us Mark Cusick, Greg Reagan, Hubert Klein, Michael Kaplan, and Lari Masten. Thank you all for joining us again today, round 2.
Hello.
Hi, y'all there?
We're
here. Great to be here. Thank you, Brian.
Great. We didn't have a lot of time last week because of the hour. We were just an hour. We've got a little bit more time today, and I do want to jump into the questions right away. But I want to ask each of you before we get started, why is it that you wanted to get involved in this series, this open Q&A for the profession, for the members? What is it that you're hoping you can help and achieve with your participation through this series? Mark?
Well, Brian, there's been a lot of issues with a lot of our clients all trying to hope that they survive. And I think that we have an opportunity to help people understand not only the risk that's going on forward, but to help them understand their cash flows, the ability to adjust their cash flows and survive this unfortunate incident. So as we continue going forward, we have the tools and the resources to help a lot of people. And if we can save some companies, then I'm all in.
Great. Thank you, Mark. Hubert.
Well, a lot of what Mark said, I agree with all of it. And it's what we hear today. We're all in this together, right? Our fellow professionals on the phone, whether they be valuation analysts, attorneys, clients, or someone else in the field who is doing this, we're all in this together, and collaboration and discussion amongst all of us is really what makes us stronger as a group and as a team. And I'm happy that the NACVA is putting this together to basically provide services to the membership and help us collaborate and get through this all together with the same understanding of the issues that are impacting our profession.
Thank you, Hubert. How about you, Michael?
For those of us who practice in the forensic arena, in the litigation arena, we all have a number of cases in process. Some of us have many cases in process. And our world has kind of been struck by an asteroid. And many of the variables are changed. Many of the assumptions are changed. We're in a world that is very highly governed by professional standards and established methodology, and many of us are faced with the questions. Many of us are puzzled as to what do we do? How do we deal with our longstanding assumptions? How do we deal with changes in the variables, changes in the world of forensic accounting and financial litigation? And together, we bring everyone together and we have the opportunity to explore them and come up with some guidance and direction. That's why I'm here.
Great. Thank you, Michael. Greg.
For me, I certainly echo what my esteemed peers have said. For me, this started with reaching out to people I've known, Hubert, Mark, Lari, talking about issues I was dealing with here in my office that I had to make decisions about, and beginning to collaborate to determine what everyone else is thinking. Lari made a comment once that none of us are as smart as all of us. I think there's a lot of wisdom in that. So for me, the opportunity was to try to solve a problem I was facing, and then it flipped and it became an opportunity that I could take what I was learning through my research and join others and share it with our whole business valuation community at large. And so that's why I'm here.
Great. Thank you, Greg. And Lari.
Yes. So I don't have a lot to add because the motivation is very similar amongst all of us on this panel to be honest. But I honestly feel like all of us together, what we're kind of conveying is that we have a sense of stewardship towards the profession and, what needs to happen with our clients, taking care both of the clients' needs and, being cognizant of, what we need to do to keep the bar up for the standards that we have already set as a profession. And so I'm here because like everybody has said, basically we've done a lot of research, we've had a lot of thoughts, we've had a lot of conversations, and the knowledge that we have now, just 2 weeks later, than our first conversations, is just tripled almost. So I'm here to make sure that we have an ability to address those. And, my desire is really to also hear what my peers have to say. So that's why I'm here.
Great. Well, Zach Myers, who also was on the panel last week, was unable to join us today. He's busy with clients and had a conflict. He'll hopefully join us on one of the upcoming series. To that point, one of the things that NACVA really specializes in and actually was founded upon was for the Main Street CPAs to understand business valuation, to grow and expand their practice to help their clients. In fact, I spoke with one of our members between last week and now, who has totally appreciated all the great resources, ours and others that he's attended. But he made a point to me, which I'll also speak to, and all of you as well, is that our members, the CVA members and the MAFF members of the NACVA, although many of you joining us may not be members or even certified with the valuation or litigation credential, but the strength or the basis behind a lot of NACVA's resources are for CVAs and other analysts to support Main Street businesses. Although you may also support public companies and larger ones. And that perspective is something that we want to keep in mind, although we can certainly address with this panel other issues for larger and other kinds of companies. But let's dive into the questions, because we've got a lot. And if you're viewing and have questions, as Chinda indicated, you can include your question in the Q&A chat box, and we'll do our very best to get to them. We've got about 40 questions already that we've queued up, but we'll also be very attuned to what you're submitting and try to get to your questions as well. So let's get started. First question, what will be the impact of COVID-19 on projected cash flow? What and how we adjust? Lari?
I'll start off because I know everybody has an opinion on this one. So I'll start off and set the stage, and then everybody else will tear my stage down, I guess. It's an amazing question, and it's one that none of us have an answer for, really. But when we take a step back and we think, what's the impact on projected cash flows? I like the fact that whoever asked this question used the word projected to begin with, because there's a difference between forecast and projected. Forecast is based on historical, what we actually know. Projections, the one that has that hypothetical in there. And I think that most of our analyses in the near term is going to include hypotheticals. Hypothetically, the company recovers. Hypothetically, the company is going to have some debt forgiveness related to the PPP program. So I like that it's included the projected piece of it. What's the impact? I think we have to take a step back and think about the different industries. And we don't have a broad brush answer to any business, how they're going to be impacted, but we can say that there's more affected businesses and less affected businesses. And the more affected businesses, it might be that their business has gone down or that it's tripled. But how we're going to project cash flow is going to be really dependent on our own analyses and our ability to cite the right questions to management and to do our research so that we can then prepare this projection. And one of the issues with projection, as I mentioned, is the hypothetical. And we are going to have to be able to support whatever hypotheticals we put in there and not forget all the little crumbs on the table that might be included in there that we don't normally address. We have hygiene in certain industries that's probably going to be changing going forward. There's additional cost associated with that going forward. So even if we have the past to look to as perspective, we have to not just consider a reduction in revenue, but an increase in additional costs that previously were not contemplated by the company. And I haven't even hit the cost of capital, adjusting for how the company is going to, fund survival in the short term. But I'll stop there and pass the buck to Hubert.
Okay, well, thank you. Well, Lari, you've said it many a time, right? If we all thought we had the answers, we all know we don't have the right answer for this. And that's really it. There's going to be a lot more work that we're going to have to do on these cases for projected cash flows. We're having businesses that are seeing a crunch in cash flow. We're seeing some businesses and some industries which are having the opposite effect, that they're generating more revenue or cash flow than they had before. And we're going to have to look at each one of these industries and companies in more depth than we generally have when we just relied on talking to management and looking at the historical impact of what happened, as well as their own internal projections, which now pretty much may be turned on their head, and they have to retool and go forward with that. One thing we have spoken about is some resources out there are trying to update and change their information, like IBIS and some other companies, regarding their product as what's going on in the industries, but there's going to be a lag time before all that catches up and gets to publication. So we're going to have to use our best professional judgment, and we're going to really, really have to push management when we talk to them about their expected cash flows, what are their projections, what may have changed, and what they think is going to be not just the short, mid, but also the long-term prognosis of what's going on here. So with that, I'll throw it over to Mark.
Thanks, Hubert. One of the things that's really important for, I think, our members and even non-members listening today is to remember that as you develop your cash flows, let's call it cash flows to equity, remember all the components that we've taught you over all these years, right? It's not only just about what your revenues are going to project to, but it's also now, how does the gross profit change? How did the supply lines change? How did the supply lines change the actual margins that we now have going forward? Make sure you take that into account. And don't forget, when you're doing your cash flow projections, to also take into the additional working capital that's going to be required to get back, the additional CapEx that's going to be required to get back. And if you have any loans that are going to be placed into play, how many dollars you're going to have to retain now to repay back some of those loans, whether they're bridge loans or not, and be able to determine how much cash flow is really coming out of this business. And as Lari had said, don't forget to adjust the cost of capital based on each one of those years going forward, depending on the severity of the risk associated with each year of cash flow that you're projecting. Hopefully, as we go out, year one would be the riskiest, but as we get back to something normal, you tend to try to pull some of that back and get it to a point where terminal value makes some sense.
Mm-hmm.
Got a good question that's kind of related to this. Go ahead, Lari, and then I'll jump in. We're getting some good questions, but go ahead, finish this thought.
I was just going to add that along with that, what we may be doing, because we do have some hypotheticals, we don't know what's going to happen in certain situations. What we probably will do is have multiple models, and we might have some probability weighting that we assign to the most likely versus least likely. So the complexity of our analysis and our models, I think, is going to be raised quite a bit, not just an expectation that we know what to do, but that we're going to have some extra time that's going to be involved in adding all this additional analysis to, what is already a fairly complicated venture, to be honest.
Poll
question. So if you're watching, want CPE, respond to the poll question. If you're not able to, send us a comment in the chat. Okay, go on.
I want to add that there's so many more independent variables that we have to consider and evaluate in doing our projections. I mean, just the ones that jump out immediately is, what is the impact on this situation on our suppliers and our supply chain, and how does that impact what we're doing? In terms of availability of supplies and costs? What is the impact on our customers? How is it going to change the market for the products that our customers have? How is it going to change our customer base? And those are just two of many, many variables that we have to take into account. So I mean, we're doing the same type of projections. We're doing the same type of work, but more variables, more analysis, and needless to say, more uncertainty.
So let me just put these two questions because they're related. One of them from Brandy. Hello, Brandy. So glad to see you. Thanks for joining us. In order to address all of the moving variables and the need to deal with the hypotheticals, how does the panel expect the added work to increase our time to complete the work? And how much of that increase does the panel anticipate being able to pass through to clients through higher pricing for valuations?
Well, I mean,
I think that's a
I'll take
great
a swing
question.
at it. It's a great question. I mean, I look at it this way. Yes, we're going to have to do more work. And yes, we have to communicate that to the client and counsel, but we don't have a choice of not to do that additional work. We have to do it. And when it comes to the billing side of it, you know, we have to manage that expectation with the client when we get retained in the job that there's going to be more work to do, but we can't not do it, and we should be paid for it.
I agree.
I think we're going to find that there's a significantly greater amount of research that we're having to do in order to do our work than we've ever done in the past. We're really going to have to dig into these businesses and understand them more than we have before, I think. Understand the vendor customer relationships. You know, we have a duty when we're relying on projections to make sure that the assumptions are reasonable. And with all the uncertainty, as everyone has been sharing, it's really difficult to assess these hypotheticals. And I would simply offer to everyone listening that the AICPA has a really good product that is designed for CPAs who are either compiling or reviewing projected financial statements. And it's designed to help CPAs determine whether the assumptions are reasonable. I think that would be a good resource to use that might help us.
Mm-hmm.
I also think we need to be mindful that, you know, we are in a business ourselves, and we have a lag on information available to us. Even thinking about any of our industry research resources that we use, First Research, IBIS World, whoever we go to naturally, all the information they have is historical too. They're just trying to predict what's going on right now, looking at current trends, but is that going to be a permanent trend, a short-term trend, just a 2020 thing to get through? So I think the time is going to be, it's going to be a longer time before our product gets to the client, regardless of the extra amount of time that we bury into it, regardless of whether or not we pass that cost on along to the client or not. I think that the expectation of the clients is something that we need to manage. And I'm currently doing that with several engagements that we have right now that had been promised out pretty quickly. And we're having to say, look, we just don't have sufficient inputs right now to make all of the analysis, let alone know what's going to happen. Just the regular research that we would normally just pick up and start running with isn't there.
We can't lose sight of the fact that we have to have open communication with our client, and we need to educate the client as to how the nature of the beast has changed.
Right.
And Larry, even when you were talking about that one particular client, that they have to have a number. If you're in that situation where you have to have that number, then by all means, you have to be able to put your hypotheticals out there, let everybody understand what assumptions you've made, and then assess the risk accordingly, right? And maybe that means the cap rate goes up because you're not really confident on what that's going to be able to replenish in 3 years or 4 years or 5 years.
Yeah, my concern is I just don't want to double dip. And so I'm going to have to be looking at probably that probability weighted model. And as I put more risk in the numerator, the benefit stream, I'm going to have to ratchet it back a little bit in the denominator based on the different models that are prepared. The question probably at some point in the next few months is going to be, how many different scenarios do you need to be sufficient? So Greg, going back to your point, there's tools out there for us to use based on what's the gravity of the assumption that we're making, and what's the predictability of that assumption. But I think we're going to be having this conversation for quite some time on what weight to give them. I think we go to 2024 and we look back, maybe 2020 is just one of those years it has zero weight to it because whatever happened this year is just not normal. right? I think we can probably all agree on that.
I think we can. And Lari, what you just said too, with the adjustment of the numerator and denominator, we probably should explain that more to some of the people who may not fully grab that, but the double dip issue is going to come to a head if we're, I wouldn't use the word overly aggressive, but if we make too many adjustments on both sides, numerator and denominator, they're going to kind of work against us, and we need to understand what we're doing, because that's going to be the cross-examination question. If you're changing or adjusting both and it's doing something to drive the value down, you got to be prepared to defend why you did that. So it's going to really change the way you think. And when you look at these, so when you look at your assumptions and you take into account the impact of the adjustments that you're making, just make sure that you're not double dipping and doubling up on the risk analysis and therefore deflating the value improperly.
Great.
I think Lari's point on the probability analysis and not to double dip the risk factor, if you're going to weight these with some kind of probability, is a big deal.
Yeah.
It is.
Sure. So a good question then to move on to our another question that's come in to this issue. In determining the discount rate, how can we avoid double dipping, since every component of the discount rate is already factoring in the COVID-19 crisis?
Oh, I don't think that's true.
Okay.
The sense it's
Clear it up for us,
factoring in.
Lari. Break it on down.
Well, sorry. I just don't think that our cost of capital has caught up.
Not yet.
I mean, and it's changing. And you look at the public market and how erratic it is. The market is the most stable that we have, and what most of us sitting here are, our task is to value a private company that doesn't have the strong management, the things in place, the wherewithal, the strength of employees, the strength of longevity to have been around. I mean, we have companies that they just started up in August of 2019, and all of a sudden, smack, here's what they're staring at. And what they're really looking at is this wall of debt that they just incurred to start business. And now we're saying you need to do it again. So back to the cost of capital, that everything's baked in there for COVID. You got to pay attention to what your valuation data is. Mm-hmm. And you also have to really give some strong thought to is what we're seeing, let's just, a quick one, an easy one, is the risk-free rate. Right. Is what we're seeing in the risk-free rate truly indicative of a risk-free rate right now? Do we have a zero risk relating to anything? Look at oil, the barrel price. It's negative in the negative 30s. It's not just a risk that we're dealing with there, it's a liability. And there are people who are trying to lump the oil and gas problem right now into COVID, and that was going on well before COVID even came on the horizon. So I disagree with the end of it, and I'll stop there, and Hubert, you jump in. Again.
Well, I agree with everything you just said, and I don't believe it's baked in yet. I think the risk-free rate is a big thing. I would say probably 50-50 between practitioners who use the spot rate versus the historical rate. For those using the historical rate, you're fine, right? The rate hasn't changed much yet because it's over a long, but the spot rate, there's a big difference between a historical rate and a spot rate. And, 2.5+ points, that could really change evaluation. Now you get into the specific company in the cap rate, though, we're not going to see these 5 to 7% anymore, right? You're going to see people doing a lot more analysis. Those specific companies may go higher, and you're going to have to do a whole lot more quantification of the factors that you considered and relied upon in assigning that new specific company risk rate.
Here's a question, and maybe even a new term, triple dip. Given the liquidity has been severely hit, isn't there also the argument of a triple dip? The discount for lack of marketability may go way up?
Well, I'll give the legal answer. It depends.
I think it depends, because you have to look at, there's so many different moving parts. And the triple dip is a great concept. I like whoever asked the question. I think it's a great question. But it's kind of like, I know we're going to talk about the alphabet here pretty soon. V's, W's, U's, L's, all of that stuff. So triple dip is just, right there. But I think we have to be careful if we are being, like Hubert said, aggressive in one area where we're just really beaten to death the cash flow maybe, so we really give a lot of thought and we've done a lot of modeling there, do we also have to do that same heavy lifting on the discount rate or the cap rate? I think the answer is yes, because we can't lose sight of the fact that this is long-term expectations with a short-term craziness going on, and we can't let the short-term craziness impact the fact that our job is to prophesize beyond that short-term event.
Right.
So the marketability is the same issue.
Right. Not to compare 2008 to now. I mean, two totally different things, but let's compare 2008 to now. What happened from 2012, 13, 14, 15 forward? Everybody, the sky had fallen in 2008, and we got out of it and came back. And the same thing, we're Americans, so let's be optimistic. The same thing's going to happen again, and we have to be careful when we consider what's happening in the short term as to what that midterm and long-term horizon impact is going to be.
Is capitalization of earnings now appropriate in favor of projected earnings?
I think in some cases it is. I think in some cases it's not. I was dealing with one case specifically where I was to value a business as of December 31st, 2019. It's in litigation. It's an equitable distribution matter. And I began to talk with the attorneys about the value of a business valuation as of that date. And so the decision was made to move it forward, but we couldn't figure out when to move it forward. And so earlier dates, like March or April, there's still so much uncertainty that, I'm probably going to be leaning more toward projecting future cash flows, at least for a 2-year period of time, until I can believe that we might be getting into some normalcy. But a lot of that will depend upon the research that I'm able to do over the next month or two. If the date gets moved out further to June or September, maybe things have changed and we're getting a little bit back to somewhat of a close to a norm that maybe I can rely upon history. Some industries aren't going to be significantly impacted by this crisis. And I think history and a CCF model still works. What do you guys think?
I think, honestly, no matter what the business, I think if you think about any business USA, because that's what we're all mostly focused on right now, any business USA, big or small, they've been impacted in some way. They have great growth because they make hand sanitizer. They're down 80% because they're a restaurant and they can only do drive-by throwaways, or giving food away. But there's a cost to every one of those types of businesses. I cannot think of a single business that hasn't been impacted. And that simple fact tells me I can't use a capitalization of earnings approach, because in the short term, something did happen. In the long term, it may resolve itself. It may be different. The company may go away. I mean, part of my probability analysis might be that there might be a 20% chance that the company's not here, right? But I think no matter what, there has to be some accommodation for the fact that cash flows have been impacted, either positive or negative. And in the short term, deal with it. In the long term, make some hypothetical assumptions.
But on the flip side, there are going to be businesses, we know a lot of them don't have cash flow projections. And all they have is the historical information. And we're going to have to consider the cap of earnings at some level. But there again, we're going to still have to do the work. What happens to the short-term growth rate, right? What happens to the long-term growth rate? What do we see that should impact the historical cash flows? And to make sure that we don't double dip and all that when we do the cap rate in a specific company, right? So it's hard to tell a company that only has historical information, we can't do evaluation because you don't have projections, and they don't do them. The good news is, my experience is people who never traditionally had cash flow projections, lo and behold, they're starting to do cash flow projections.
Yeah.
The one thing, guys, that you got to remember is the fact that when you're looking at historic, that's got to be your baseline, right? You got to find out when you're looking at your projections, how much am I moving away from my baseline that we had before? How much longer it's going to take me to get back to that baseline, if it's even possible, or to exceed that baseline? So looking at your historicals isn't just a matter of a waste of time. I think it's important to understand where you were and how the impact was there, and the risk associated with moving back and forth to that place and time. And I just like everybody listening to remember what the capitalization model is versus the DCF model. And all you're trying to do, the only difference between the two is capturing that nonlinear growth and or change. So it's just a matter of understanding, how do I quantify that change? And I guess, you got to go back to purpose as well. If you're sitting, for example, in a marital situation, you're doing a divorce case, be careful when you're doing that projection analysis. If you're changing that cost of capital and you need an infusion of cost of capital that's not part of the marital estate because it's 2 years down the road, be careful that doesn't increase the value of the company with assets that aren't part of the marital estate.
Right.
So you got all kinds of issues that you have to deal with. Just make sure you're trying to quantify that change, that nonlinear issue, because once you get back to terminal value, you're right back to the capitalization model. So just be careful about what you're trying to capture and how you do it. And don't forget about purpose, and don't forget about your standards of value.
Here's a question from Bill. Why can't you use a cap rate and take a reduction for the value of the current year?
I don't think anybody on this panel said you can't. I think our position is that, and Mark just made it clear, you have to look at history to understand, and that way you can put into the framework of having an understanding where the business was and have a real good understanding with management, how it's impacted them on a forward-looking basis and a model. But, nobody said that you cannot use that. It just says that we're going to require a lot more lifting to truly understand, and then also be prepared. If you're going to have to testify or writing a report for regulator, incorporate that into the narrative so you can explain it so the reader understands.
That's a good point.
And one tool
the story is going to be a big part of what it is that we're doing now, because that's about the believability, to be able to not only take the information that we have and calculate it, but then also tell the story behind how you develop that information. And if that's believable, your calculations will be much more believable. Sorry, Larry.
And no, that's fine. One tool that we all have that we've used for a different purpose is the H model in adjusting growth at the end of a DCF. And what we're talking about, we haven't really wrapped the language around it yet, but what we're really talking about is we have the short term, we might be using an H model on our discount rate in the short term. So we might have a 3 to 4 year forecast / projection that we're looking with different risk rates tied to each one of those specific cash flow events. And it might be a 6 month, it might not just be years side by side, it might be 6 months at one risk and 6 months at a different risk. So we might be taking the H model concept and modifying it in some way to adjust down our risk rather than looking at it for long-term sustainable growth concepts that we've typically used it for. So there's that.
You spoke to some resources, Lari, and we have a comment from Bruce. And it's more of a comment than a question, but it's as to resources. And he's saying, I think you should all read Professor DeModern's discussion as to why you should not normalize the riskless rate. There was also another article written from someone with Morningstar saying that they also do not think it was appropriate to normalize the riskless rate. Can you speak to that?
Well, I think what he's talked about, and I'll reserve my opinion on this for a second, but what he's bringing up is Stephen Phelps recently announced that March 20th, I believe, 23rd, effective that date, that they've done two things. They've modified their equity risk premium, and they've increased that from 5% to 6%. And then they've also said that if you're going to use that modified equity risk premium, we suggest that you use a normalized 3% risk-free rate. And so that's where that whole concept starts. So basically, Stephen Phelps has said, hey, we're on record that your minimum starting point for your cost of capital is 9%. And there are some really good arguments against not using a spot rate. So DeModern is one of those that's in that camp. And I think none of us can say, here's the right answer, here's the wrong answer. You need to really take it in concert with what's the purpose, what's your actual valuation date? Is it January 31st? Is it March 31st? Is it June? Is it upcoming? But you need to do your research and buy in, basically, to that normalized risk-free rate and the normalized equity risk premium before you just jump full, 2 feet in and say, hey, I'm going in that camp. At least that's my thought.
And my thought is when you start looking at the minor adjustments that those come into play in comparison to the overall cap or discount rate, that's the least of your problems. You have to deal with the unsystematic risk that is there for each and every company when you're putting that company specific risk together. Now what is that point? Where's our range from our cap rate and our discount rate based on the industry, based on what's happening in each one of these companies? And you're going to be moving that company specific risk. Sometimes if you've really been really affected and you're not really sure that the industry is going to survive, maybe that goes up 10 points, or 15. You got to quantify it somehow, right? And one of the other guys on the panel had talked earlier about how you have to really put the analysis together and quantify and use tools to quantify that unsystematic risk like we've never had before. And now maybe you come up with 15 or 20 or 30 more different factors and somehow try to quantify what that risk is going to be, because it's not one point.
Right.
I can almost guarantee you.
Well, how many times have we seen in the past that somebody has a higher than 10% specific company risk, and we all kind of smile and say, all right, we're going to dig into this because this can't make, guess what? It's coming down the pipe and we're going to say, you know what? They might have understated it. So you're right. We're going to have to quantify it. We're going to have to see how the other side quantified it and see what makes sense.
Yeah, because the bottom line is risk is out the roof today for almost all businesses. We know that. And so we can't just use the traditional approaches that we've always felt comfortable with.
There's a couple questions that are going back to a topic that really kind of overrides everything, and that is dates when things were known or knowable. We talked about this a little bit last week, but it's still quite relevant. There is a great resource, if you all are not aware, with Valuation Products and Services. Valuation Products and Services. If you Google that, you'll find the company, VPS. It's run by Jim Hitchner and a great team of supporting experts, Eva Lang, Karen Warner. They put together a free resource on their website. Do you want to speak to that so that folks, certainly it's important that we address that and get that resource out there and we can jump back into these topics. But I think it's worthwhile just touching on really quick.
Well, I think it's important. I mean, I've read it and understanding the timeline, and it puts it out there rather nicely with dates and what events were happening. And there's some of the law firms around the country have done the same thing. I guess they're dealing with similar issues for their client and damages cases, who knew what, when type of thing. So there's a lot of good resources out there. The Hitchner product is very good, easy to read. So if you get a chance to take a look at it, but I think that's part of the process. We all have to educate ourselves on the timeline. Greg has talked many times, he's doing 1231 valuations. And when you start looking at the timeline, he's like, I don't want to be the ostrich that puts my head in the sand. And that's how all this got started. So I think, Greg, you're probably one to talk about it too, because the timeline's important to you.
Well, it is. And most of the work that I do is in litigation. And in litigation, you're looking at some kind of a settlement today. And if you're using numbers, that it seems pretty clear to me. When I first started all of this, none of us really knew anything. We were all researching and learning. But very quickly, I think over a 2-week period of time, as Lori alluded to earlier, suddenly there was a lot of knowledge. A lot of us were researching, a lot of us were sharing information. And Jim Hitchner was one of those who took the time to actually take all of the historical events that were taking place around the world and tie it to the S&P 500, the Dow Jones, and the Russell 1000. And he showed the changes in the stock market. And it became clear that during January and February, as this COVID virus was beginning to spread around the world, our stock market was actually increasing in value. And in March, it became clear that something began to change. And on one particular day, I think it was March 21st, it started a downhill slide. And so it makes it pretty easy for an argument to be made that here in the US, we didn't know until sometime late in March that this event was taking place and having an effect on investor decisions.
So there's a lot of great resources out for that. In fact, on the NACVA.com/COVID 20-19 page is the recording of the webinar from last week, where the panel got into this a little bit more. There's also on that same page the NACVA and our Global Association, along with the American Society of Appraisers and the Royal Institute of Chartered Surveyors, hosted a town hall. God, it seems like 1,000 years ago, but it was only on April 8th. That recording is also available on that landing page where this topic is discussed. Lots of great resources out there. Here's a good question for you all. And thank you all for watching and sending these questions. They're great. We're going to try to get to them. So this question: how do you quantify the unsystematic risk given that the Delaware Chancery Court doesn't consider, rely on, or believe in company-specific risk premiums?
Well, I think
problems.
historically they may not have, but going forward, they're probably going to be convinced, because you can have a company, identical revenues, identical everything, but in two different parts of the country. One of them is going to be impacted specifically because of their location or their suppliers or something, and the other one will not be impacted the same way. And so this whole non-systemic risk has got to be super tailored nowadays. You know, Mark, you brought it up, but we are really going to have to focus really hard on specifically this one company. And in the past, we've probably just kind of gone, yeah, well, it's going to be 3 to 5%. And we already talked about, yeah, 10% is probably not going to be something unusual, right? Here going forward. But I think what will happen is that there's going to be a lot more investigation, the sniff test on what did this analyst actually already include in the cash flows?
Right.
And does it smell right at the end of the day? You know, does it make sense? Which then brings in, and I know we haven't talked about this yet, but this brings in the market approach and looking at historical transactions. And we're kind of focused today on cash flows and discount rates, so that's an income approach. But really, at the end of the day, our sanity check still has to be there. We may still be using market data to say, well, in general, you know, is this company marketable? Is that going to help us just identify the higher end of the range for a discount for lack of marketability or the lower? But we can't forget that our toolbox has, you know, 3 common ways of valuing: asset, income, and market approach, and we can't just throw some of them out the window because we think it doesn't fit now. Honestly, my probability weighted models are probably going to include some heavier reliance right now on the asset approach, because the likelihood that a company is going to go out of business is probably a lot higher now than it ever has been, right?
I think something we need to think about with the market approach as we move forward, you know, over the next year or two, the businesses that are selling now, you know, they may not really be selling willing buyer, willing seller. If we're trying to assess fair market value, businesses that are pretty strong and good shape, they're going to hold back. They're not going to sell right now, in my opinion. I think the businesses that are selling are probably those that are distressed. And I think the values are driven more by the crisis. So I don't know that they would be good measures of fair market value.
Right. Well, there's probably a lot of revaluation of people's interest to purchase businesses. So we know that's going on with people revaluating deals. As far as, you know, the Delaware Chancery Court, you know, someone's going to make the argument, and courts are usually receptive to good arguments. So I would say now is a good time for someone to make that argument with the right case and the right facts. You're going to get that through. And don't forget, there's a whole host of other courts out there around the country, federal and state, that do allow the specific company risk. We have to keep that in mind too.
And one other thing that you guys need to understand is the argument that there is no company specific risk means that every company in every industry with the same size would have identically the same cost of capital. And that's just not possible, right? So if you did the build up and you're building it up and you use the same equity risk premium and the same size premium for that decile or whatever methodology you use, you're going to come up to the same number. And the only difference is the company specific risk. And we had the same exact discussion when we were at the Internal Revenue Service on companies that were multi-millions of dollars. And all 3 of them, and they threw out the company specific risk because they said it was subjective. And then we came back to them and asked them, okay, well, if that's true, then well, how come you now have the same risk factor for all 3 companies in 3 different industries with 3 different factors? They didn't have an answer for it. So ultimately, yes, there is subjectivity to the creation, but it doesn't mean it doesn't exist. So now it's up to you to tell your story to be able to really develop that and we won that argument. So don't automatically just throw it away and think that you can't win that argument. You got to tell your story, but you need to develop it. It needs to be very company specific.
And that's a great success story, Mark. And I'm glad you brought that up, because what it comes down to, at the end of the day, the work that we do is not a mathematical calculation.
Right.
And that approach to the IRS sounds like it was just a mathematical. You can't have any subjectivity. Well, then you're not doing your job as an expert, because it's supposed to be your expert opinion, not your correct math calculation.
Right.
I think
well, in support of that, we have, if we go back to the market approach, because I did bring it up, is the other side of what Mark and Hubert were just talking about. If there was no company-specific risk, every market multiple would be exactly the same for the same size of business, and we know that that's not true, right? And so what is the difference between those companies? It's company-specific risk.
Exactly.
I mean, it's that simple.
And you have to be able to explain it. I was on a conference call yesterday with 4 business court judges in 4 different states. And the general consensus was the judges very often don't understand this stuff, don't understand what we've gone through. The juries certainly don't understand what we've gone through. So whatever it is that we consider, we need to, as Mark pointed out several times, tell the story. We need to tell the story and let the trier of fact understand the process that we went through and the struggle that we went through to identify which variables we were going to adjust for and how we were going to factor it in. And, you know, the telling of the story often becomes as important, or maybe even more important than the numbers that underlie it. That was a dangerous statement that I made, but yeah, the numbers have got to be good, but you got to be able to tell the story in order to persuade the trier of fact.
But when it comes to persuasion, you really need to build into your story as much objective fact as a foundation for your subjective decision as you can.
Absolutely. It has to be supportable.
And if you don't have the objective facts, and if you build your story upon evidence that's not subjective and not admissible, then the whole thing's going to unravel. So you've got the facts to consider and the admissibility.
For those of you who, to this point, telling the story, writing a report, and NACVA does have some great training on report writing, both for valuation, for litigation, which brings up a good question. What about the distinction between calculation of value and valuation?
Well, I think the work that we're going to be doing here in the short term is probably only going to rise to the level of a calculation, to be honest. We might title it something different, but thinking about what's the distinction between valuation and calculation. For all of you who've submitted great questions about things like marital dissolution, there's an imminent need to get a decision made, and we have a December valuation date, or we had a September or an October, something last year valuation date. We have a, you know, something that we really have a fire under us to get the answer out there. I think part of the answer might be don't offer up a conclusion. One option might be, here's a calculation, here's a place marker. Let me update it when we know more information. But calculations versus conclusions, the distinction really is that a conclusion has allowed you as the analyst to look at everything, look at all the methods, look at all the information available, and come up, in your opinion, with the best answer. And a calculation is a lesser product. You have some restriction in some way. We typically think about the restriction being the client restriction and a budget restriction. Client doesn't want to pay for it, or, you know, it's an M&A situation, we're just giving a range. But what we might now start considering from a professional standpoint is that limitation might be on the other end of the scale. It might be that we don't have sufficient relevant data, right? We don't have sufficient evidence to actually come up and rise to the level of a conclusion.
You know, Lari, I think it's also important, though. I think the calculations now are more dangerous than ever. And when I say that is because if the calculation already starts at a lower amount of analysis than the valuation, And we're all talking about now we need to do more work to try to get through this process, right? And to try to understand the effect on not only our forecasting, but our projections on all different types of the model, from margins to everything that has changed. How does doing less work help you get to a better answer just by doing the calculation? Because historically you might have a base, but that historical is not going to help you much going forward. And that's usually what we use most of the time on those calculations. It was always about the base, unless you're in, of course, an M&A situation where you just, looked at new hurdle rates and new cash flows based on the assumptions.
Well,
Let me add
Go ahead, Mark.
to your comments on the calculations. In the area where I typically practice, which is in the courtroom, in the world of legal disputes, I will take on a calculation only if it is humanly impossible to complete a valuation that meets the professional standard of care.
Agree with that.
And client constraints are not good enough. That they don't rise to the level that would cause me to take on a calculation engagement. Assuming everything else is there, everything else is available, only if it's impossible to complete a valuation and formulate a conclusion of value will I take on a calculation. But we're finding in the current world that with the uncertainties, that there are going to be more and more situations where we don't have the comfort level to offer a conclusion of value. But we need to put a number out there or numbers out there to enable the parties to resolve their differences, to resolve the dispute. And the calculation, which is the only thing we can do given what's available, may be the way to go, may be the only service that we can offer to the clients, to the legal practitioners. But again, it's in those specific circumstances.
And I agree with you, Michael, but here's the practice pointer that I've seen, having done cases like everybody else in multiple states. Triers of fact don't really care between conclusion of value and calculation. Because if we use the same methodology, we look at the same information, and we point out, well, the client really dictated what they did on the calculation versus our conclusion. Judges don't care, especially if the numbers are pretty darn close. So it's going to be tough. I mean, obviously, in a litigation setting on a damages case, obviously there's no calculation. So you're
Right.
going to have a conclusion of whatever your opinion is going to be. And other litigator, like in business divorce situations, calculations really don't pass the scrutiny. I've seen them more accepted in matrimonial courts, but courts, they're going to say, point out the glaring differences other than that language that says what they did or what they relied on from the client, because you all had the same information. You got the same cap rate, you have the same income stream, you made similar add-backs, and your number is close. It's going to be an interesting thing, but I do agree with the uncertainty that maybe some calculations to help get things done may be better in certain courts. But I still think they're going to want us to take a position. We can't hide and say that we can't have a concluded value based on all the known facts at the valuation date. But we do have to be prepared to forward it and say, well, how did what happened from December of 19 till now impact that value, and what could it be? Because if you can't answer that question, judges are going to discredit anything you might have on your conclusion of value.
Hubert, I agree with you that when the numbers are close, the trier of fact may not care. But when the numbers are completely different, what's your opinion?
Oh, that's a whole different ball of wax when the numbers are different, because then they can't hide behind the fact that their client told them to do X, Y, and Z. And had they done X, Y, and Z, they would have come out closer to you. Well, then they're done. I would say their catfish is fried at that point.
My perspective is similar to Michael's in that most all the work that I do is litigation driven, and because the judges and the attorneys don't really understand our standards, they don't understand these methods. They just want a number. And I personally feel I have a duty, from a due diligence and a due professional care perspective to do the best I can to get a number, because I've just seen so many times where I finish my work and I release even a draft, and then they go settle the case, and I never finish it. And because all they wanted was a number that they could start negotiating with. So I'm leery personally of calculations in litigation, but that's just my personal situation.
So 2 questions here that kind of relate to this topic, and I'll put them both out so you guys are doing such a great job. And again, thank you for spending the time with the profession. The first one is, but how do you quantify it? Not whether, how do you quantify it? Whether or not it is applicable, how do you calculate it? First question. Second question is, in issuing opinions of value, should I consider ranges of value versus one number because of uncertainties?
I'll start backwards and then let somebody else answer the first part. So absolutely, you can give multiple numbers, but I think that's kind of what I was talking about, or what we've all kind of talked about, this probability weighted model. It depends on the purpose. You know, the IRS is not going to take a range. They need a number. Sometimes the user of our work needs a number. And so in those instances, I think it's going to be us doing some probability weighting. Well, there's a 40% chance of this happening, a 20% chance of this happening, and then 20 for these other 2 options, so that we come up with a number that we've caveated. Here are all the hypotheticals, you know, back to how do we follow our standards. Here are the hypotheticals that have been incorporated in here, my assumptions that have been incorporated in here, and to my best knowledge, this is right. I think the mistake would be to use a probability weighted model and then apply a standardized set of discounts for lack of control and lack of marketability to it. Because each probability model that you develop, you're including different risks in the numerator and the denominator. And so your adjustments for lack of control, lack of marketability need to be different. So that probability weighted model needs to be the end conclusion and then weighting those appropriately. Or at least that's one way to solve the problem.
I agree with that, Lari.
I agree with that. And one of the things you have to look with that, with the probability weight. So, I mean, I had a matter where somebody on the other side came in and they had ranges of values. They had 13 ranges of values ranging from 1.2 million to 13.5 million. And well, these are my ranges. And so for the person's question on ranges of value, it's okay to have some, but be prepared. The case settled because we just said, well, explain to us how you're 1.4 and 13.5. And when we took a look at the data used in the modeling, you know, it was basically you change one thing and it changed everything drastically. So, you know, it's good to give ranges. I think the ranges should be somewhat tight, not to expose yourself. So I think that's one thing we should take into consideration. On the other side, where how do we quantify? The same way we've always quantified what we're doing in that specific company. But there's going to be other questions, you know, real depth looks at supply chains and its possible impact, and where is materials and things of that nature coming from, and what is the likelihood of something happening there where the goods originate. I don't think we've traditionally said, okay, they have 5 different suppliers, there's no concentration of suppliers, everything's fine. Well, this is going to make us take another hard look. 4 suppliers in the US, but the main suppliers out of China, you know, we might have an additional element of risk that we have to contend with. If 50% of the product or 40% of the product is made, you know, from those goods that come in mostly from China, but they can get alternative suppliers in states, but the price point is 20% higher. It's something we have to consider.
Your practice into your
Those hypotheticals are critically important, because then the focus of the conversation goes to not which number is correct, but how do we cite the hypothetical condition and which one do you believe is correct. Because if you solve that question, then you'll know which one you're going to select, whether it be the higher or lower number.
Because what I'm going to go over,
I think that's where we have to remember the 3 R's: relevance, reliability, and reasonableness. So we have to support each one of those, you know, probabilities or hypotheticals, making sure it's relevant at the time that our evaluation date is, that it's reasonable, that we can support, you know, that might be an outcome based on certain metrics.
Thank you.
And that at the end of the day, the number that we come up with, whatever we proffer out to the user, has to have some level of reliability and reasonableness, you know, to it as well.
Mm-hmm. And then you have to have the last one, believability, right? You have to believe in the number you put out there. Right. So, you know, a lot of these questions are asking us certain things that we would all do our own analysis for our 3 R's. But we are also willing to say, if we put the number on the paper, and we submit it to the user, we're going to stand behind it too. And that's the other thing. You have to believe in what you're doing and that you'll stand behind your work product.
There is a question here as to a topic we've been on, but let's get a little bit more into it. I'd like to hear the panelists' opinion on if we can still weight the market approach. Are historic market comparable transactions not considered applicable anymore?
I think we can still use them because, as we kind of talked about a little bit earlier, you need some kind of sanity checks on what you're doing. This probability weighted model concept of doing a DCF, you need some sanity check. But what might be different is the weight that you give the results and the level of discount. So if we look back in time, we have 5 years of transactions that we're using to value the company now. We have to consider what's the company's marketability now. So what might happen is we might be using those transactions, but our discounts might be higher because they're accounting for economic and industry phenomena right now that were not in evidence at the time that those market transactions actually took place. It's interesting, I have had a texting back and forth with a friend of mine, many of you know, Mike Adhikari, and one of the things that he brought up about the numerator, and I think it's very valid, is that possibly this discount that I'm talking about, this adjustment, might be a period of time of cash flows or cash loss, not just the loss due to lack of revenues or of selling products and services, but the cost to right the ship, so to speak, to get the company back on board. Either that might be a primary way to come up with our discount, our additional adjustment to the market approach, or it might be at least a good sanity check on what we're doing under the cash flows and does it make sense with the market. And if we can look at the difference in our indicated value between the market transactions and our discounted cash flow analysis, does that in some way hover around the hole in the cash flow that is actually occurring that we can see?
Well, along those lines, though, have we seen any evidence that the ratios have dropped? The times revenue earnings numbers have dropped, or are they just at the same multiple, but they're just looking at new cash flows? That's it. We're gonna have to see when that's factored into the marketplace too, because if you look at the long-term trend of market multiples in certain industries and what's going on out there, the market multiples kind of stay within a fine range for mature businesses, and they'll adjust it based on the new forward-looking cash flows. You're not going to see a multiple go from 8 all the way down to 2 times on the same the drop in the cash flow number. So we're going to see that. And as far as the marketability discount, based on what we knew as of December 31st, yeah, there's a larger marketability discount, but price always drives market, right? So if you don't want the marketability discount, you drop your price, your business becomes marketable, and that hasn't been factored in either.
Right. And my comments were mostly directed at the completed transaction method, not looking at the guideline public companies. So just want to clarify that.
Right.
Just a quick housekeeping note. If you all have missed a poll question and have been attentive, you can send a message through the Q&A or chat to let our administrators know you're here. The webinar is actually going to be 2 hours, not 1. Last week was 1 hour, but we extended the time to 2 hours. So just a quick housekeeping on that. And we'll move to a really good question here. I'm going to punt this to you, Michael. Past performance has been historical. Past performance has historically been used to project the future, but now everything has changed. In litigation cases, courts want and need your valuation opinions to be based on reliable considerations. Can you provide us with examples of reasonable and supportable considerations for future earnings projections and the resulting business valuations?
When we're taking a valuation into the courtroom, and this holds true if we're taking a damages analysis into the courtroom, when we are using historical data, we better be prepared to, number one, explain how we bridged the gap between the historical data and our projection. What is it? What was different? What's different now? How has the COVID-19 impacted our market, the market of our customers, the market, the variables relating to our suppliers, our labor force. How have those impacted the historical trend, the historical information, in enabling us to put together our numbers going into the future, our projected numbers. But we have to be able to bridge the gap, and we have to explain it and have to be able to tell the story. We have to do additional analysis. We have to do additional diligence in ascertaining the reasonableness of it. And we have to reach out to the research services, the data sources, and use the best data that's available, and be able to explain it to the judge and or to the jury.
You know, Michael, the one thing that is important too for people to understand is, you know, everybody's looking for the one question or the one answer that fits all, and it doesn't exist. In every single solitary case, you're going to have to use all of your skills and all of your knowledge that you've been taught over the years and apply everything going forward based on the facts and circumstances of that case. For example, if you're in a company and they're doing hand sanitizers, their sales are off the charts. The question is, for how long, right? And then what are you going to do with those type situations? I remember back in the day, we had the same type situation dealing with steel. And this company was not a manufacturer of steel, but they were a broker of steel. And all of a sudden, I mean, it was an ESOP, they were going down, and before you know it, their inventory was just to the max. And they had so much inventory and so much steel and so much leverage that their shares were going at pennies on the dollar because they weren't able to even survive. Could they make it to the next level? 12 months later come along, and their entire inventory was sold. And it was not only just sold, but at 1,000% returns on what they paid for it. Why? Because China bought up the entire world steel supply when they were building. And as a result of that one transaction in that one market, the world steel supply disappeared, and now it was at a premium, right? Well, how is that any different than another event like this, right? Now, that only affected the steel industry in that particular case, but you have all of these different nuances that are going to happen going forward, and you're going to have to understand, just like the steel company and those projections, that they're not going to get those types of returns again, because in order to replace their steel, they're back in the marketplace with everybody else, right? And now they're buying steel based on that new norm. So their margins are changed, everything has changed, and their forecast has changed. So you have to take a look at what's going to happen, how long you think this is going to impact that particular company, how are their suppliers, what about their customers, right? What if their customers are in an industry, for example, you're a supplier to restaurants, and it's not only just a question of whether you survive, but if those restaurants survive, right? Because now your client base is going to change.
Right.
So it's ultimately different for every single entity, and you have to take a look at it when you're doing every aspect of those cash flows and then document.
Right.
Well, we've got a question here.
Well, Brian, I just want to follow up on that, because that was from our buddy Alan, that question. So
Right.
he asked, you know, for specifics. Well, take it for instance on a cap of earnings. We have a company growing at 8% a year, right? All of a sudden it has one bad year and it goes back to its 8% growth model. We're going to take a look at that, and some of us are going to say, well, that was an outlier year. Maybe we're not going to count it because the future, you know, for whatever we figure out what that blip was caused by, we might not count it. Well, that same thing works on a DCF model going forward. If the year going forward because of this looks like a negative or a down year, but they expect to recover in a year and a half and 2 years out, you know, then we're going to look at, well, how much will this down year really impact it if they project that they're going to be back to where they were on a forward-looking basis. So, you know, that's the practical pointer. You're all going to have to make your judgment call. And, you know, hockey stick recoveries don't really happen in a lot of businesses, but they do. It's going to, like Mark said, we're going to have to do a lot more work on, is that projection believable? As Lari said, challenge those assumptions, make sure they're credible. But in practice, that's what's going to happen, right? We're going to see this. And the question is, valuation is basically a prophecy of the discounted future cash flows today. And we have to look at, on the forward-looking model, how big is this impact going to be on the long-term perpetual growth or perpetual history of the company.
Well, but what about companies that are actually booming? Do you need to adjust cash flows down as an adjustment based for previous years or go back to DCF?
We don't know yet. Listen, I believe you could have a saturation point in hand sanitizer, right? Everybody's not going to have it everywhere, but if you went to Demoterin did this one analysis, he said, with his class, where he asked them to project the growth of Netflix. And at the end of his presentation, and everybody did it, he asked him, he goes, when is the spaceship going to land? Because they did projections so far out into the future that the subscriber base outpaced the human population growth, subtracting annual deaths. So you have to do your work.
But some companies are booming. How do you deal with that?
Well, there's no.
Well, I think it's no different than the companies that are incurring a bunch of costs and losing revenue. You model it in. You model in this blip, and you determine, is any element of that potentially something that's going to last into the future? Are there some legacy issues that might be there? We now have this delivery-based, demand from, pretty much all of society right now. And is that going to increase costs for restaurants? Are they going to have to cover some of that going forward? But at the end of the day, what we need to make sure that we add to our reports, no matter how we manipulate that benefit stream, is good language on disclosure for what we have done. And one resource, I think it was Michelle Gallagher that brought this up last week, that is out there. I think you have to be a member of FBS. I am, so when I log into AICPA, I just get it. But they have this great toolkit of a lot of information out there, and one of them is suggested language to go into your valuation reports surrounding everything that we're talking about today. So if you haven't looked at it, somebody let me know. Can you just get it for free? Or if you're an AICPA member, or do you have to be FBS? I don't recall that part of it, but it's got a ton of information in it.
It's also
Brian, even for the companies that are doing well right now, and for the companies not doing well, it still remains to be seen. We're all sheltering in place and working from home remotely from somewhere, right? Well, the trend in real estate had been brick and mortar was slowly fading away. So there's going to be a change in the cost structures of a lot of businesses who will not be paying rent and having people work at home after all this, and more efficiencies built in. And we're not even going to capture that now in a forward-looking model, because we don't even know what that's going to be. But if you look, for a lot of companies, brick and mortar is one of their main costs on their P&L.
Yeah.
One of the other changes is even the car dealerships.
Yep.
I mean, Carvana, if you looked at their stock recently before this happened, it was at $25 a share. It currently was sitting at $71 a share. What changed? People don't want to interact because of the virus, and as a result, they're buying cars online.
Yeah.
Is that going to continue? Are they going to want to continue to do that and not sit in a car and feel a car and go back? Or do they like the fact that the car gets delivered to them? They have 7 days to try it out and send it back.
It's actually kind of cool.
Right.
Demand is coming down as expected, but given that competition is also facing the same issue, pricing may come down, may or may not come down. What are some approaches that you are using to adjust pricing? That's really a business.
Is that relating to pricing of our services? Is that a question about?
That might be actually a question for individual businesses, is they've got to figure that out to stay competitive. I'm not sure how that might factor into valuation issues, but.
Well, Brian, I think that it's also going to be their supply chains and their margins, right? That's going to affect their pricing. If their supply chains are getting tighter to the point where, the supply and demand happens and their pricing goes up through some type of inflation, they're going to have to reflect that in their prices as well to get their margins back. Otherwise, they make a lot of business. So I think that's going to be a case-by-case basis.
Okay.
Yeah, I mean, we don't know. We can't tell what the direct relationship is to dropping their prices, to their margins, and is that going to make them profitable enough to stick around?
Right.
So much
we know
of that
that
is yet
the
to be
airline
seen.
industry has tried that for years and it doesn't work.
No, they just nickel and dime you on everything else,
Yeah.
Exactly, and it makes me as a consumer angry. So
I heard they're going to add $200 to the cost of a seat for them to Lysol it before you sit there going,
Yeah. Well, we're going to punt now to a topic, another question. Will earnouts become more common for business sales during COVID-19 recovery phases?
I think that's a good question on transactions that are going on right now, because part of the issue is it may not be preferable for either the buyer or the seller to have the earnout, but it might be a necessary element just because all of the banks are all tied up in all of the bailout money and the PPP and the SBA loans going on. There's just, they may be in a situation where you can't get borrowings for something like, I'm going to buy a company right now. So the earnout may become, much more, I think is a great question. It may become much more commonplace. I think the question will be, this is a completely different topic because I do want to keep us on topic. We're here about the discount rate and the cash flows. But for fair value purposes, when you're thinking about, what the market participants are going to be doing and what's going to happen with debt, I mean, I think that earnout and how you capture the true value of that earnout, can they actually meet these, markers and be successful? I think we're going to have to pay a lot more attention to how we kind of quantify the earnout from the purchase price allocation standpoint.
I think the earnout is also going to be how people are going to minimize some of the risk profile and being able to determine how those forecasts are going to come in and how accurate those forecasts are going to be, and have the owners take some ownership of those forecasts.
Or you're going to have the real business, right? The seller's going to want cash and really not want the earnout. The purchaser's going to want the earnout, and what kind of discussions are going to go on between them and a business perspective, because earnouts don't always work, especially when someone else is controlling the business. And I think we'll probably see an uptick in post-acquisition dispute work as a result of that if there are more earnouts.
Yeah. Can you address how DCF projections and WACC should be adjusted in business valuation?
That's a good question, and it's going to be a tricky one. We focus on one side of the equation. We were talking about the build-up method. Generally, you have it, but you're really going to have to take a hard look at it because the value of your cost of debt is going to skyrocket depending on what you're doing with your cost of equity analysis. I don't think there's one simple answer for that, but you're going to have to take a serious look at it because theoretically, if you use either one, a weighted average cost of capital or a build-up method, you should be close. Based on some of the preliminary math and numbers that I've seen and run, there's going to be a big difference right now. And now it's the issue is how do you reconcile that and explain it?
Yeah, just
well, and I think part of that is going to be, you have to give consideration to whether or not, what's the nature of the debt? Is it part of one of these programs? Is it going to be converted to a grant type situation? What's the likelihood that the company maintained the right number or percentage of employees and used the money in the right way? Could it be debt forgiveness? We brought this up last week, and because we are talking about the benefit stream this week, I want to talk about it again today, is that we can't lose sight of these programs are out there, and now there's going to be a fourth program out there that we need to keep, get up to speed on. And we need to be modeling that into our DCF. If we thought operations are going to be exactly the same, but we have a company that has participated in any of those programs, we need to consider, is it a program where they're going to be paying back at a 1% interest rate? Oh my God, what's that going to do to your WACC, right? If you look at your debt. And then is it a sustainable percentage of debt to equity forever into perpetuity? Probably not. And then if they don't have to pay it back, they've foregone the cost, but they get a tax shield. They have a tax savings because they are paying payroll and paying rent, paying utilities. So at the end of the year, they're going to write that off as an expense and they get a tax shield from it. So I think there's going to be lots of webinars on, we could just talk all day about that once everything kind of settles.
In fact, right before joining you all, I was meeting with Rebecca Smith, Garth Tebe, and William Manchero. We will be scheduling in May a webinar on this Main Street Loans program. Is that what you're speaking to, Lari?
Mm-hmm.
Yeah.
Yeah, so that will be forthcoming in our series. And Rebecca Smith, Garth Tebe, and William Manchero will lead a discussion on that, how to help your clients in managing those engagements in those loan programs. Okay, given the massive toll the bailout funds will take on the federal budget, how would you deal with the S corporation adjustment now? But this, it would sunset with the QBI deduction. What, or how would you assume that now? Also, if you're valuing a C corporation, do you factor in risk that even though the C corporation lower rates are permanent, they may be raised to pay for the deficit? So C Corp versus S Corp.
Well, I'll start with the QBI and the sunset. I think the assumptions that we put into our analysis have to be based on what current law is.
Yes.
Could it change? Is there a probability that it'll change? Is there, you know, who's going to win the election? We deal with this all the time, right? So I think we have to live in our lane of what's the current law and carry those assumptions out, you know, based on what we know is in existence right now. Personally, and I know I've had conversations with many people that are on this panel too, that really this whole concept that there's a difference in value between S Corps and C Corps right now has kind of gone away a little bit because the C Corp tax rate changed. We had the QBI for the smaller S Corps. So there's kind of an equal weighting. If I would lean in one direction or the other, I would say S Corps might have a worse off situation because they have that limit on the QBI. And so a sizable S Corp is going to have a worse position and less value than a sizable C Corp just based on tax rates. But Brian, that was a long question. What was the second half of the question?
Oh, it was.
So the first piece is QBI in S Corps, and I don't think anybody disagrees with me. We probably just need to live with what the current law is.
Current law is. And to be honest, I've been involved in a lot of transactions where if it was an S Corp that was selling or a C Corp, the people buying it don't even look at that issue. They're looking at the cash flow, what they're getting their hands on, and nobody's going to pay 15% more for an S Corp if it's a C Corp buy. They just don't care. They're looking at the cash flows and what are they going to be able to put in their pocket. It's a great intellectual discussion for us to have, but real people don't quantify it even if they consider it. They're not going to pay more for an S Corp over a C Corp because somebody believes there's some embedded premium there.
The second part of that question was, if you're valuing a C Corp, do you factor in a risk that even though the C Corp lower rates are permanent, they may be raised to pay for the deficit?
Oh, well, I think what we'll see is we'll see an impact on equity risk premium. We'll see impacts in other areas of our modeling and our inputs outside of just that tax piece of it. But I think that's something that we just have no way of identifying right now. But I still kind of go with the mantra of stay with the current law and what it is. But yeah, it's a great point that you've got to pay for this somehow, right?
Yeah. So if management wants to redo their forecast for 2020 through 2024, and you have not issued a 2019 valuation, what should your response be? If management wants to redo their forecasts for 2020 to 2024, and you have not issued a 2019 valuation, what should your response be?
Well, if you're valuing
go
the
ahead.
business, I'm sorry, if you're valuing the businesses of December 31st, 2019, all of this COVID was not known or knowable at that time. So, you know, I don't know to what degree you take into account changing projections because of COVID.
Not to mention the purpose,
Well, I think,
right? Without understanding the purpose of that question, you don't really have an answer.
But if a report hasn't been issued and you were relying on cap of earnings and now they have updated projections for you, you'd surely want to see them, right?
Depends on the purpose.
Yeah.
Would we ever say no to that though?
I would.
Really?
Yeah,
Well,
because
I
if
think
it's
has to
not
come
known
into
and
play.
foreseeable, that those projections should not have the covert embedded in those projections. Otherwise, it would be as though it was known and foreseeable. Like, for example, if I had a particular divorce case and I was valuing a company for a divorce case and we had a retirement plan or a 401k plan there on December 31st, what was the value of the 401k plan on December 31st, right? that number is going to be at a time and place with all those portfolio stocks that was prior to the COVID information.
Okay.
That could have been valued at $1 million. 3 months later, that's now valued at $250,000.
Right. Well, that would be a passive asset. We're talking about an active asset.
Well, I understand.
Business.
I understand. But the reality of it is, if I was going to buy that stock on that particular company on that day, I would have paid the $1 million for it because that's what it was worth.
Yeah, but I think the question was the valuation report hasn't been issued. It was for 12/31/19. I mean, I would listen. I don't believe it would change my opinion as of 12/31/19.
Right.
But I don't want to be in a position where if Greg, you brought this up, we want to consider the impact of COVID-19, at least not be able to say, yeah, we considered it. It doesn't change my opinion at that date. And I freely acknowledge something might have happened post that date that impacts the value currently, because we're all going to get asked that question.
I agree 100% with you. My point was that the number as of December 31st wouldn't change as a result of a new forecast.
No. And that was my point is, would we want to see them? And I said, sure, we'd want to see them and look at them, but that wouldn't change.
Yeah, and to the degree you analyze them, maybe that's part of your subsequent event disclosure that you put in an addendum or somewhere in your report to let the reader know, here's the value as of December 31st based on our standards and how they're applied, but looking at the market today, obviously there's been a change. The value is either up or down depending on how COVID has impacted that particular business.
Now, I got a flip question for everybody here, Brian, because we've been focused on and assuming that in these litigation cases, hypothetically, we're probably working for the business owner and we're getting everything we need. What if we're on the other side and working for the non-business owner and we're not getting everything we need? And, the forecast projections and the historical stuff and all that, that even puts us in a bigger box of trying to quantify all this and come up with our conclusions and opinions of value.
It's true.
So that's another area.
I think we can't lose sight of common sense. Honestly, at the end of the day, what was the purpose of the report? Why are we issuing the opinion? Who's going to use it? Is it going to matter to them after the valuation date what the value was? ESOPs have in place, Department of Labor has an option to do interim valuations to update for things like that. The IRS, for estate tax purposes, acknowledges that crazy things might happen and you might need an alternative valuation date. That concept that is in place by regulators right now is something that we can rely on and say, right, all of you have said, and you all disagree with me about this, but all of you have said, we can't change the valuation date. No, I can't, but I can certainly go to the judge, and I think the judge wants to hear, here's an opinion, but it's worth jack crap because it's on this date and I followed my standards and the company paid me all this money to do this. It's not worth anything today. So if the judge is making a determination today and that will make a difference, I mean, Mark, think about your divorce case and you've got a $5 million value on December 31st, but it's $1 million now because they are only going to be able to do a certain amount of work going forward. Part of what they did isn't useful anymore in our society. It's now only worth $1 million. Is the judge going to say, okay, you owe her $2.5 million or owe him $2.5 million?
It depends,
There's
Lari.
no money to pay it.
Well, it depends. Is he going to take the 401k that was at $5 million on December 31st and say, okay, now we're going to divide it $2.5 million a piece? Or are they going to bring up that also down to the $1 million and now you both get $500,000 each? I mean, it's like you either do the whole marital estate or you don't, right? I mean, it's all part of that.
It brings up the point that we are not the decision makers.
Right.
We're the analysts, and we have to give the decision makers all the tools that they need to make the decision. And unless we put them on notice somehow in our reports that they're making a decision on something that we personally believe is changed in value, we're not doing our civic duty to them. Right.
I think it's important for them to understand that we're not doing apples and oranges, that we keep all of the assets, like, for example, in the marital estate on that December 31st date. Then we also have to inform them that, yeah, today it may not be worth anything, but on that date it was worth this because we didn't know that this was going to happen. And as a result of that, if you want to change that, that's fine, but then all the assets need to be changed.
Well, in this environment where we're trying to value businesses and we haven't issued our report yet, and we've been given a date, in North Carolina, and all states have their own laws about this and they vary, but many states have a requirement that you value the business at either date of separation or something equivalent in a current date. And so in my case, I've got a long-standing divorce dispute and a very old date of separation date, and then a current date. And the current date was initially assessed as December 31st, 2019. Well, when all this broke out, I started talking with legal counsel who had retained me, talking with the client. They started talking with opposing legal counsel, started talking with the trier of fact, and ultimately decided that it was in the best interest of everyone to move the date to July. And so you have an opportunity to educate, as Lari was saying, the parties who are the decision makers and let them decide. And then whatever they decide, we have to do.
And it boils down to what is the purpose of the valuation? Who's going to use it? What do they need to know? And from the perspective of disclosure, we better disclose everything that we know, everything that we have that they need to know. Because if we don't, it's going to come back and haunt us.
Mm-hmm.
And notice what Greg said. He said that the trier of fact moved the date to July based on everybody's recommendation. But that means all assets would be valued as of July, not just that personal stock.
Correct.
That's a unique thing, I think, to North Carolina and maybe a few other states. A lot of other, especially here in the Northeast, there's hard, fast rules on valuation dates that we kind of have to live by, even though the trier of fact may want the update, especially in matrimonial courts. They're a lot more less formal than the commercial courts. So that's one thing. It may be possible. I do think even if you don't include it, you better know the answer, because a matrimonial judge is going to ask you the answer. And if a civil court or a commercial court judge tries to ask you the question, you're going to spend 2 hours on objections and why it's objectionable, as opposed to a matrimonial court where the judge is going to say, please tell me. So
I agree. I think had the trier of fact in my case stuck with 12/31/19, I would have had to value the business on that date, but I was going to, somewhere in my report, have some sort of information relative to the diminution in value because this business closed its doors on March 31st.
And that includes all the other assets of the marital estate too. There has to be a roll forward valuation, especially for the passive assets.
Well, yeah, you've got active passive appreciation that you have to consider.
Right.
And we also have to keep in mind that, this is, I know we mentioned this last week, it's worth repeating, this is not an event that people are unaware of. Everybody who's a user of our report is going to understand COVID-19 is an issue. So we're acting and responding in some way as if our hands are tied and nobody's going to understand. This is almost the perfect way to have a subsequent event. It's happening everywhere, right? And so it's not, the hard part is not going to be getting the users of our report, no matter what our date is, to understand that this is an element. I think it goes back to what you just said, Hubert. We're going to have an answer. Whether you put it in your report or not, you better probably look at what those forecasts are that the client just sent you for 2021 through 2024, because you're going to need that to be able to respond. Because if you just go, yeah, Judge, it's an issue, what's the answer? I don't know. I mean, that's not going to fly.
No,
right?
But it's also,
you have
Lari,
to do the work.
It's also important to understand that you could very easily, in that particular situation, double the amount of work you have to do on that valuation report. When you give another opinion, you better be prepared to not just kind of wing a calculation to give that opinion. You better be able to support that opinion. And if you need a report on that opinion, you better be able to come up with that answer.
Right.
Which goes back to that earlier question about what are we going to do on fees, because now what used to take 20% of our time is now going to take 80% of our time. But I think we also have to be a little bit sensitive to, we shouldn't be double dipping on the client's checkbook. If we're doing the initial work and we're sticking to, this was December 31st, 2019, why waste our billable hours on something that we know is not going to be useful? Take some time at the beginning of the engagement and try to right the ship a little bit, and then use those client resources that are very scarce right now wisely. And then that's what's going to get us, back in as a recurring analyst or expert for those clients. Is we're, trying to do the right thing, and we're all in the kind of the same boat, and we're trying to take care of each other from that standpoint, rather than just jacking up our prices for no reason. I think, I don't know if we said this last week or not, but it's akin to having to pay $20 for a roll of toilet paper right? You go to the store and you pay $20, but you know, you have to because that's what it's worth right now. But you know, when this has calmed down 5 months from now, I'm probably not going to go shop at that same store anymore because they gouged me. They took advantage of the opportunity to do something.
See,
And I think
Lari,
clients are going to be
that's really
sensitive to
fair.
fee.
I think there's two ends,
I don't
and I
think
think
that's
Mark is
fair.
going to hit on that right now. But I don't
I
believe
think-
anybody on this panel or anybody on this webinar is fee gouging. But if there's an added cost, it's not unfair to pass some of that added cost through to the client, as long as, like we said in the beginning, manage the expectation, let them know that we need to do this, because if we don't, we're not providing the right service to you because we know the questions are coming.
And it's also good,
Exactly.
like with Hubert, I didn't mean to cut you off, but I
Yeah.
just wanted to add to your point. Greg's point and how he handled that was outstanding. They talked about it before you did all the work for December 31st and said, guys, this is what's going to happen. And that discussion about the date needed to be done, and they moved the date so you didn't waste your time doing something they weren't going to use.
And
I
that
think
went a
that's
long
the
way with
critical
both sides. That went a long way with both sides, not just the client, but the opposing side and the court, that you alerted them early on in the process. And you know, that's a win-win for you, Greg.
Right, that's a win-win. Unlike doing the report, I mean, you could suggest to change the date. The problem is that it all depends, because you might get one attorney that wants that date, like say a divorce case, that wants that date to stay at December 31st, not to lower the value of that entity. And then you got the other attorney, depending on who owns what, that would definitely like the date change. So again, it's going to be an argument amongst who wants the higher value or not, and whether you're going to change the date or not. Because I've also been in a situation where the attorney was like, no way are we changing that date, right?
Yeah.
So
Well,
you have to be careful.
What about the question of advocating for a specific value, and how the analyst is to be involved with advocating for a specific issue? Can you talk a bit about that?
You're talking about advocating for a value? Is that
Yes.
what was his question?
Yes.
Well, I guess
So-
it depends on what context we're in, right? If we're helping parties and trying to help them in mediation or trying to settle a case, we have a different hat on than if we're the valuation analyst drafting a report for use in the litigation. So, you know, it kind of depends on what role we're playing, and then what are our limitations if we put on that mediator role. Are we really going to be able to go back to being the person to represent them if that mediation blows up and goes into litigation?
Well, I look at advocacy two ways. Number one, I cannot be an advocate for the client who hired me. But once I do my work, and if I remain objective and unbiased, I follow the standards, I'm thorough and comprehensive in what I do, and I form my opinions, I will fight for my opinion. I will be a strong advocate for my opinion, not for the client who hired me.
Well, I'll rephrase the way I put it. You have your valuation, you've done it. Now they want you to help them talk about a global settlement, and there's stipulation on a narrow range of the value. And now they want you to assist them in carving up the economic pie. That is a different form of advocacy than an advocacy from your opinion. So I agree
It
with what
is,
you said.
yes.
But a lot of people on this call probably do both of those. And I think there's a gray area that a lot of people get into. You know, you fight for your opinion because it's your opinion, not your client's opinion. And then you kind of morph into that role where they want you to help them with settlement. But usually you have to have stipulation on a lot of the major facts on the values of things before you can even step into that role. But that'll take you into another realm of advocacy.
Yes.
I just like to add to it, there's also another time, I mean, you could be a consultant and hired to help somebody buy a company or for the lowest price or sell it for the highest price, where you are the advocate for that particular place.
Right.
I think the distinction is whether or not you're giving your opinion or not.
Right.
And if you're giving your opinion, then you don't be an advocate anything other than your opinion. But if you've been hired as a consultant to help buy or sell a company, I think you absolutely can be an advocate for that client. That's exactly what you're trying to do. So again,
Yes.
purpose comes into play.
Absolutely.
Great.
Oh, right. Good questions. How would you address funds received from the Payback Protection Program? And wouldn't analysis remain open until there is some idea of the amount that may be forgiven?
Yeah, I think you have
I
risk.
think I think it's a good question. And I think that goes back to the probability, because seems like, and I might be wrong, but it seems like in the last 2 days, I've heard some scuttlebutt that they're going to be increasing the criteria, making it a little bit stricter going forward for what amount is going to be actually forgiven. And it's all stemming from those 75 public companies who actually took chunks of money away from the small companies. And so I think in the super, super short term, I don't think we can do, we don't know. But back to the tax question, live with what we know the rules are right now, and that's the best we can do. So if we look at the rules right now, we're doing evaluation, March 31st, 2020, look and see what the rules are right now. Did the client participate? Had they used the funds wisely? And then maybe part of my probability model might be not necessarily just my cash flows from the income statement, but what's going to happen with my working capital.
Right.
Yeah, there's going to be quite a bit of normalization needed, I think.
Yeah, but like the rules are the rules right now. That's what we have the best to go on. Listen, when they pass the Tax Act or any tax act, the next 2 years are full of technical corrections. So we don't know what sort of technical corrections are going to come out of this PPP program and all the new stuff that's coming out. But if we talk to our client and our client says, I used the money for payroll, I didn't lay anybody off, I followed the letter of what they said, we have to believe them, right?
Are any of you in the valuation adding a PTE to your valuation? I'm hearing that some think that it's presently none.
Can you, is it Paul Echo? Did you just say PPE like math?
Paul Train Echo, PTE.
Price to earnings?
What does PTE mean?
Yeah. How they're using that. That's it.
Okay.
I feel like it's a spelling bee. Please use it in a sentence.
Yeah. So if you answered
Pass-through entity is what he said in the chat.
All right.
Pass-through
entity.
All right.
Pass-through entity.
Read it again,
Well,
Brian.
Yeah, read it again.
So well, let's speak about
Question is,
pass-through entities and
are any of us
valuation.
adding PTE to the valuation? But the pass, if we're assuming right that means pass-through entity, we should ask the writer that question to clarify, because the entity is the same. I mean, we can't control the type of entity it is.
Right.
Okay.
And if there's any premium or adjustment because it's a pass-through entity versus another form of organization, I think we've already covered that.
Yeah, we covered the C corporation, S corporation issue.
And if there's Brian, if they send you a specific question, offline, when we have a better understanding, we'll all be happy to answer it for them.
Okay. Are you all planning to look to or rely upon for projection timelines where you switch your projection from COVID affected to post-COVID?
Well, I think that you're going to have to look at what's going to happen over time, right? I think if you're looking at 2020 in your projections, that might be different than 2022, which I think would be different to, at what point in time do things become normal again? And that's tough to do. But I think that ultimately that's why you need to understand your base and where you came from, and then how that correction is going to alter that base. Sometimes you might go beyond that base and grow it bigger and stronger than you were in the past. Sometimes you just have to get back to that base, and what does that mean, right? So when you look at your terminal value, I don't think that unless you have a company that put a whole lot of capital infusion in, you're going to grow a lot of companies that are going to go much past where they were in the past, 3, 4, 5 years out. I just don't understand how they're going to do that. They may do that, although then you need an explanation as to how they're going to do that. So you're not doing this in a vacuum. You're working with management, and you have to put these puzzles together and ask a lot of questions before you can determine how this is going to impact a lot of what's going on. And, it's not about just asking the CBA. It's about asking the client and asking them how this whole thing is going to do, and what's the plan, right? What is their plan to come out of this process? Most people have.
Well, and I think we should also pay attention to what's going on, and that's COVID. And what does the healthcare sector think about when we're going to have a vaccine? Can we have a vaccine? Are we going to have, there's here in Colorado, as an example, there's discussion that the schools for K through 12 won't even be in face-to-face school learning through the fall. It won't be until January of 2021, because there's some thought that there'll be, with the flu season and everything else, some resurgence of COVID before there's a vaccine for it, or a way to treat it a little bit better. So I think when we're looking at how far out that goes, and when do we stop and go back to normal, I think a good place to look at least is, the people who are trying to solve the problem, what are their thoughts on when it's going to get back to normal? And everything I hear is we don't know.
Right. Well, would it be interesting is if we had this webinar 2 years from now, compare and contrast.
Well, let's put it on the calendar.
Where are we versus what
schedule
happened?
it, yeah.
That's a good idea.
Looking
But Lari-
forward from the storm, what market indicators will you follow to gain an understanding of when the effect of COVID is no longer consideration in determining value? It's kind of what we're talking about now, I guess.
I think there's going to be some effects that are going to be forever. I mean, just think about TSA, travel before 9/11. I mean, there's things in place that are just natural parts of traveling right now, and travel and hospitality, that never existed before, and they'll continue for a long time. So I think there's some things that are going to stay. I don't want to be speculating in areas that I shouldn't be speculating, but I would hard guess, that things like food service and personal services, there's going to be a lot more focus on hygiene long term, and how those things, those services, personal services, are delivered.
Right.
So
if you look at it, look at the airline industry over the years, right? Airlines used to fly many more flights than they've flown pre-COVID. Some of those flights were half empty, and they finally woke up and said, less flights, more people. And then smaller seats on flights. Then we had 9/11 hit and all the TSA, and that was going to take a tremendous toll. And we all worked our way around, the more secure checks at airports, and people were flying more. We have a dynamic economy. Things will change. Yes, there'll be more sanitary issues we have to deal with, but we're a consumer-based civilization here in the States, and we'll figure a way around it. And that creates innovation, and other people will develop new businesses to fit those needs. So I don't think it ever truly goes away. I think over time, it just gets more and more discounted as a risk threat to do what it did today, because what happened in the last month and a half, I am sure that people are going to be more prepared and have better processes and procedures in place to deal with it on a forward-looking basis, that to not allow it to have the economic impact it did. So we're a dynamic civilization, and I would say that we will be prepared, but it'll never be totally off the risk radar, but it will be discounted as technology evolves and other things evolve.
Yeah, I think there was a lot of things that are going to change looking forward, like supply chains and various other things that we're going to learn lessons to. To this day, you go through an airport all based on 9/11, and we still take our shoes off when we go through security. And, unless you have the upgraded passes where you can then go through the process. But, ultimately, I think there's going to be some things worldwide that are going to change, just from the ability for this to spread so fast and so quickly, and the response to a lot of different governments to protect that particular scenario. For example, the way that they shut down the United States and travel, if something were to break out again tomorrow, I would think that would be an automatic solution, that all countries would just automatically shut down travel between everybody and try to contain it within certain borders a lot sooner. So that you wouldn't have this massive impact around the world.
Well, and I think the whole work from home is going to have a big impact on all businesses, because business owners are now realizing, they were forced to get into a situation, most of them that weren't essential, of allowing their employees to work from home. And, from a productivity standpoint, maybe they're not quite as productive right now because they've got the kids home too. But long term, they might be saying, hey, that extra 20% of commercial real estate that we were negotiating for, we don't need now. We can just, hotel our cubicles for a while, right? So I think the lesson, Hubert's right. I mean, we'll just change as how we do business. I mean, how much more efficient is it for us all to be having this conversation than if we all had to fly to Philadelphia and get on a plane and get a hotel room and then all come and meet and have the same conversation, right? I mean, I get to leave and go have lunch, and I don't have to worry about, travel. So I think from a cost perspective, one thing that we've talked about, and I'm trying to be back to the cash flows and the discount rate, from a cost perspective, we need to be equally sensitive to the cost savings that might occur as
Yes.
we are to the costs that are going to be added in addition to historical operations.
Right.
And the cost savings in the new ways that we do business going forward, based upon the things that we've learned throughout this situation, through this environment.
Right. Well, and I think Mark Cuban said it last week. I bet there's going to be a new awakening of a second economy. That's just how dynamic we are as and resilient we are as a people. That is going to create a lot of opportunity, and we're going to figure this out and march forward. And what we're dealing with today is a temporary situation, but we're going to, whatever normal is going to be going forward, it's not going to be something we're going to regret, I don't think.
We've got just a few minutes remaining, and this is a great question to summarize and close on. And can you comment on the impact to the overall demand for business valuation services and where we might be headed in the future?
Upward.
Upward. Up.
I think the analysis that's going to be necessary going forward is going to be massively important. And I think that not only from a valuation standpoint as to what the value is, but how about your risk profiles, and how about, understanding your capital and needs, and all of those different components of valuation are all available to each and every one of us to help really solidify the foundations of a lot of companies.
Yeah,
I think it's really
I was talking with somebody in litigation and a bunch of attorneys who had spoken to some judges, and they basically said, get your old stuff done, because my courtroom is going to be packed come the end of this year with new cases. So that's why I'm saying, they're generally a good barometer of what's going to happen. And as for those of you in litigation, for those of you not in litigation, there's going to be a demand. If business values are down, estate and gift tax planning people are going to go through the roof to try to transfer some of the pieces of their estate, taking advantage of the gift and estate tax planning rules with discounts and everything. So there's going to be a demand for services.
We've got someone on the line who is not a CVA. They are a CPA. And they're asking what kind of resources or what kind of support would be useful for them dealing with value in their clients.
Well, we can go to the NACVA website, which hosts all the resources that are available that all of us have. They can go to any of the other organizations' websites that have them, but you're going to look for resources that deal with risks and rates of return, industry-specific information, whether it's Integra or IBIS, depending. And so I think those are the places to go. For us to sit here and recite them all, that could be a whole hour conversation too.
Yeah.
But there's a lot of information out there.
I
And
think
BVR is another one.
I was just going to say, I think for someone who doesn't carry a valuation credential, I would encourage you to take advantage of the training that's available through the NACVA.
Absolutely.
The NACVA was formed many, many years ago for CPAs. When I joined back in the mid-90s, you couldn't become a CVA unless you were already a CPA. And it was a place where CPAs could really learn the tools about how to value businesses because of our experience in business and our understanding of financial statements and tax returns and all of that. And just for me, for my own opinion, I think the training within the NACVA has really been fine-tuned and really been developed in a good way. And I think it's really stellar. And so I recently hired a new employee, and she was asking me what to do. And I said, I think you should go to the NACVA, get their training. And so that would be my advice to this person.
Well, I think also a good resource to use the credential designee and member directory on our website, because if you are a CPA not practicing in valuation, you can certainly find others in your area who are.
That's true.
Who might be able to assist you and help you. Certainly there's great training and resources as you all are mentioning, but there are also resources and experts probably locally that might be able to help you, that might be able to refer business with you or support you on those engagements. So there's a couple options for you, because I do want to recognize that we have some folks who are viewing this who are not valuation analysts and are curious to what they do.
Brian, the other thing is everybody on this panel, including Zach, who's not on here today, our information is public. You can go look us up and find out and send us an email. We're happy to answer questions and help direct them to the right resources at the NACVA and how they can move forward. So, you know, this webinar shouldn't be the end of the training. It should be the thing that sparks learning. I found out a long time ago, you never stop learning in this profession. And even as a CPA, you never stop learning. So that's why we have these, but talk to us one-on-one, email us, and we like to collaborate with other people.
So in closing, we do have this webinar picking up again, where our panel will continue discussing these great topics to give you advice and guidance. There's some other topics that are currently going. We'll be back with this panel on April 27th and again on April 29th. Thank you all for joining us. If you missed any of the poll questions, just shoot us a chat or an email, and we'll be sure to work with you to get your CPE. We'll post it to your account at nacva.com. And let's just have a quick round robin from each of you on your closing remarks. And again, thank you for spending some time. We covered a lot of ground today. So Mark, closing remarks for us?
Yeah, just feel free to know that you're not on an island, that NACVA is there for you. All of us are here for you. Feel free to pick up the phone. Like Hubert had said, we're more than happy to help you in any way we can. We do it all the time. And just remember that you're not alone.
Michael?
I want to build upon what Mark said. I can't begin to tell you how many times I pick up the phone and call individuals who are on this panel and other individuals at the NACVA, because they have expertise in many, many different areas, have other perspectives, and everyone who I've reached out to has been very helpful and more than willing to help. And you know, just call headquarters and you'll be put in touch with someone who's in the industry, has a particular expertise, and that'll just expand your understanding and what you can do for your clientele. Stay tuned.
Greg?
I would just say the whole reason we're having this webinar series is because I reached out to my colleagues for help to collaborate.
Yeah.
The greatest value I have are the friendships that I have with these people who drop what they're doing and talk to me about what I'm struggling with, and I do the same with others myself.
Mm-hmm. Lari?
Yeah, so keeping it brief because I'm looking at time. Two things. One, I will repeat what I said last week, and it's still true today. None of us are as smart as all of us together, and so we are a community. We're here, you know, to all help each other. You guys help me just as much as I help you. And I want to thank everyone who's taken the time to attend, the attendees, participants. You have had great questions. Unfortunately, we have not gotten to answer all of them. We've had hundreds, literally hundreds of questions submitted. So we will continue this on next Monday and the next Wednesday. But thank you all for your time.
Yeah. And Mr. Cusick.
Well, like I said, again, we're all in it together. Everything that everybody has said already, I concur with. And, you know, ultimately, we do have 2 more events scheduled next week. And if you didn't get your questions answered, we will be reviewing those questions and hopefully get to them. If there is something specific and we didn't get it and you're in a hurry, feel free to reach out to us. We're more than happy to help you.
Yes. So by going to nacva.com/COVID-19, you can see all of the great courses we've got scheduled, including next week, the 2 remaining sessions on this topic. Thank you all for joining us. Again, if you missed a poll question, that's okay. Just reach out to our headquarters team and let us know that. You'll be able to log into your account at nacva.com to access your CPE certificate 5 to 10 business days after today. So thank you for joining us. Thank you to this panel. And we'll be back next week to have further conversation of resources to support you in your practice and with your clients. Happy Wednesday.
Thank you to my colleagues.
Thank you.
Have a great day.
Thank you all.
Bye-bye.
Thank you.